It's a strange thing. So many brilliant people are just awful at investing. And there's actually a term for this. It's called the behavioral gap. It's the difference between what the market returns and what the average person actually earns. And that gap, it can be as much as 2 or 3% year after year. The problem isn't intelligence. It's a fight between your rational mind and a brain that was built for a completely different world. So the real question is, how do we outsmart a brain that's literally been millions of years in the making? Let's get into it.
So get this. This quote comes from Sir Isaac Newton, one of the smartest people who ever lived. And he learned this lesson the absolute hard way. Back in 1720, he invested in a company, made some good money, and cashed out. Smart, right? But then he watched the stock keep going up and up and up. He got that classic fear of missing out, and he jumped back in with everything he had, right at the top. Well, the bubble burst, and he lost a fortune. We're talking over $3 million in today's money. Now, if a genius like Newton can get wrecked by his emotions, what chance do the rest of us have?
And that story right there gets us to the heart of the investor's paradox. See, being a successful investor isn't really about being the smartest person in the room. It's about being able to control your own behavior when everyone else is, well, freaking out.
And who says it best? Warren Buffett, of course. He nails it right here. Newton's mistake wasn't a failure of intellect. It was a failure of discipline. He didn't have a system. So what this all means is that the single biggest threat to your financial future probably isn't a stock market crash. It's the person staring back at you in the mirror. So why is being disciplined just so ridiculously hard? Well, it's because the mental tools that kept our ancestors alive for thousands of years are the exact same tools that are wrecking our portfolios today. Let's dig into why your brain is just not built for Wall Street.
Think about it. Our brains are designed for one thing: short-term survival. To make super fast, gut-feeling decisions to avoid immediate danger. Like a lion jumping out of the bushes. That system is amazing for staying alive, but it's absolutely terrible for building long-term wealth, which needs patience, logic, and the ability to just wait.
And those ancient survival instincts? Today, they show up as these common behavioral traps. Herding, for instance. That's our old instinct to stick with the tribe for safety. But in investing, it means we all pile into the same hot stock, usually right before it crashes. Or recency bias. That's our brain tricking us into thinking that whatever's happening now is going to happen forever. These aren't signs that you're dumb. They're just mental shortcuts that our brains take, and they often lead to some very, very expensive decisions.
Okay, but out of all of these biases, there's one that's king. It's called loss aversion, and here's what it means in simple terms. The pain you feel from losing $100 is about twice as strong as the joy you feel from gaining $100. We are literally biologically programmed to avoid losses at all costs.
And this graph shows it perfectly. Just look at the curve. See how much steeper it is on the left side in the losses area compared to the right side for gains. That incredibly short downward slope, that's loss aversion in action. It's the reason you get that pit in your stomach during a market tip, that gut-wrenching urge to just sell everything, even when you know you shouldn't. So these biases aren't just interesting little psychological quirks, right? They have a very real price tag attached to them. Let's actually put some numbers on the damage that our instincts can cause. Just imagine your portfolio takes a really big hit. It drops by 50%. It's painful for sure, but it happens. Now, here's the question. What kind of gain do you need just to get back to where you started? You need 100% gain, not 50%. You have to double your money. This is the brutal, unforgiving math of investing. And it's why our instinct to sell when we're scared is so destructive. It locks in those huge losses and makes the climb back almost impossible. And that urge to sell is driven by another powerful impulse called action bias. See, when we feel anxious, when we feel like we're losing control, like when the market is tanking, our brain screams at us. Do something, anything. But the crazy thing about investing is that most of the time, the absolute best, most profitable thing you can do is nothing.
Here's a great way to think about it. It's called the goalkeeper's dilemma. Statistically, a soccer goalie has the best chance of stopping a penalty kick if they just stand still in the middle of the goal. So why do they almost always dive left or right? Because it looks and feels better to do something and fail than to do nothing and fail. It's the exact same impulse that makes us sell at the very bottom of the market. The action feels useful even when it's the worst possible move.
So let's put a price on it. What is the real cost of giving in to that fear? What's the price of trying to be a hero and time the market perfectly? It's staggering. It's truly staggering. Studies show that if you missed out on just the 5 best days in the stock market over a 20-year period, your total returns would have been cut by nearly a third. And here's the kicker. Those best days, they almost always happen right after the absolute worst days, the exact moments when the market timers are sitting on the sidelines in cash.
Okay, so we've laid out the problem pretty clearly. Our own brain is the biggest threat to our investments. But here is the good news. You can fight back. You can actually build a system, a behavioral shield, that protects your money from your own worst instincts. Benjamin Graham, the man who literally wrote the book on value investing and mentored Warren Buffett, he knew this stuff decades ago. The secret isn't to try and outsmart the market. The secret is to outsmart yourself. And the way you do that is by creating a solid plan before things get emotional. And building that shield really comes down to 3 simple things. First, you make your investment plan when you're calm and rational, not in the middle of a market panic. Second, you write that plan down and you commit to it. It becomes your rulebook. And third, you just focus on your own goals. You have to turn off the noise and ignore what everyone else is doing.
Really, you should think of your investment plan as a kind of circuit breaker. It puts a calm, logical process between an emotional trigger, like some scary headline, and a destructive action, like hitting the sell button. It basically automates your discipline, so your emotional brain doesn't get a vote.
And that brings us to the ultimate lesson in all of this. If there is one thing you take away today, let it be this simple but powerful truth. Real, lasting wealth is not built by making brilliant moves in and out of the market. It's built by picking a good strategy and then having the discipline to just stay put through the good times and the bad.
So, I'll leave you with this one last question to think about. Take an honest look at your own investment strategy. Is it built to react to the daily news? Or is it designed for one main purpose? To protect your long-term goals from your own very human, very predictable short-term emotions?